All right. What's up, everybody? Hope you guys are doing great. Welcome to our session this evening, 2023 Market Outlook. Hope you guys are all having a heck of a night. This hopefully will be a session that everybody gets a ton out of. Reason that we did this session was we thought it would be a really good opportunity for everybody to just talk about what do we think is happening. What do we think is happening with the markets on a big picture perspective? And I know that we do daily trading rooms and we do futures rooms and we do options rooms and we do all of that. And we've got our Wealth Essentials model portfolio and all that stuff. And so for a lot of you guys that see us on a daily basis, this might be something that you hear us talk about a lot, right? But one of the things that I find super important is that everybody has kind of a plan on what to do. And I always do it at the end of the year. I really like to look at this at the end of the year. So that's kind of the purpose for this evening. And really want you guys to use the chat box. Want you to use the chat box. Want you to feel comfortable typing into the chat box. If you want to use the microphone and ask a question, please do so. I think we've maybe locked out the ability for people to to share their screen and things like that. But we will still be here. I want you to ask questions. I'm also broadcasting on YouTube this evening. So if you're watching on YouTube and you want to type into the YouTube chat, I have that screen up as well so that I can do it. So what I plan on doing this evening, is really talking about big picture market and looking at the market from a 30,000 foot view, right? What are the things that we're looking at that can drive the market going forward as we head from 2022 to 2023? And when we look at 2022, when it's all said and done, looks like we're going to have had a down market for the year, right? Looks like when it's all said and done, for the first time in a long time, the market will have had a down year. And what in the world does that mean for people, right? What does that mean for people? What are they going to do heading into 2023? And what can we do about it? So I know most of you on here are already Traders Army members. So those of you that are, awesome. You guys know exactly how we talk and some of the things that we'll probably cover. Those of you that are not members, welcome. Glad to have you. Please use the chat box. We're a super big community here. We want to share things with each other. So what I'm going to do tonight is I'm going to start with big picture. And we're not going to start by looking at the stock markets, because the story this year of our stock markets has really not been the stock market. It's not. The story of this year has been the US dollar. And what the US dollar has done has really driven the markets more than the markets themselves, right? So I want to start by talking about the US dollar. Now, what happened literally yesterday, right? What happened literally yesterday that was important to our dollar? What happened yesterday? We saw our interest rates rise by 50 basis points. And so let's talk about the ripple effect that has on our economy, right? What does a 50 basis point interest rate move do from a ripple effect on our economy? Well, a couple of things. First of all, it makes capital more expensive. And when we say that it makes capital more expensive, it's the risk-free interest rate. That's what we look at. It's the risk-free interest rate. So it makes capital more expensive. Now, by making capital more expensive, the two areas that are going to be most important for our economy, number one is going to be business investments, right? Business investments. And those business investments, now it might make sense for those people that are looking to borrow money, or those people that are looking to expand their business, to go out and use alternative sources of capital, right? And that really opens up things like private equity groups, right? There's going to be a lot more private placement funds, I think. You're going to see a lot more companies moving to private equity, moving to venture capital, moving to other forms of financing for their businesses in 2023 than we did in 2022, and certainly more than we did in 2020 and 2021, right? Now, what does that matter to the markets? Well, where are they not going for their money? Well, they're not going to the traditional banks, which is our financial sector. The other place that it becomes very impactful is in the mortgage qualification sector, right? What it does is it minimizes the number of people that will be able to get a mortgage, and it'll minimize the number of people that can get a mortgage. It'll minimize the number of people that can do all of those parts that have to do with mortgage qualifications, and it will also decrease the amount of foreign investment. Now, when we hear that, what do we think about, right? I don't know that it lures foreign investment. I actually think it might decrease a little bit of the foreign investment. Now, why would that be? In my mind, that would be because I don't know that we're going to have as many people that are willing to invest in the U.S. markets if the capital is that much more expensive. Okay, I think that if there's more people that are less willing to invest in the U.S. markets. So now, what does that mean for the value of our U.S. dollar overall? Well, I think it means that we've got higher prices in the U.S., right? That is a good point. Liz types into the chat, for those of you guys that can't see it, that are maybe watching on YouTube. She types in and says that, except that everyone else is also raising their rates, right? UK and the EU did a 50 basis point rise today as well. I don't know that we're competing against other countries. I think we're competing against private funding. I think that's really where you're going to see the competition, is in that private funding and in private placements, right? I think you're going to see. I think there's a lot there. There could be more private placement funds as well as money coming from outside of the traditional financial sector. Now, what does that matter to the stock market? Well, what it matters to the market in all reality is, where are we going to find those dollars? Where are we going to find those opportunities? So let me share my screen here real quick, and let's look at the trip that the US dollar has made this year. Okay, so this is my chart of the US dollar. Okay, now for those of you that are unfamiliar with this chart, what you're looking at is the value of the US dollar index. Now, what is the US dollar index? The US dollar index measures what is called global purchasing power of the US dollar. And it's measured against a basket of the world's other currencies, right? And it's the world's other fiat currencies: the euro, the yen, the pound, the Aussie, the New Zealand, the euro, yen, Aussie, Canadian dollar. Those are that it's really, really measured against, where we're checking to see what does it look like, right? And so when I'm looking at what the dollar has done this year, we saw that early in the year, the dollar had a very, very strong rally up, right? The dollar was gaining a tremendous amount of strength, to the point on that dollar strength. If I go back and look at a weekly chart, now each candlestick here represents a week. We're looking at the US dollar's value over the last 3 years. Now, what is interesting about this value of the US dollar over the course of the last 3 years? Well, if I take a look at this movement that we see right here, this is the value of the dollar dropping. Now, this dropping of the dollar value is because we flooded dollars into our economy. And so right in here, we made the conscious decision to say, you know what, we're going to slow down the flooding of dollars into the economy. The stimulus checks slowed down, the free money, things like that. And so as we see the dollar start to rise, because we're not flooding the markets, the reason that this rose is mostly because other countries still were. Many, many other European and Asian countries were still flooding the market with their currency. Now, when they flood the market with their currency, ultimately, what does that do to the value of their currency? All right, what does that do to the value of their currency? Well, what that does to the value of their currency is it drives their currency down. It waters down their currency. And when this US dollar index is the measurement of our currency against the rest of the world, the analogy that I tend to use is that right here at 100, what that means is that 100 US dollars will buy you $100 of stuff all around the world. Global purchasing power parity. That's what I look at, right? Global purchasing power parity. So right now, the US dollar is actually above that 100 point. Now, why is that relevant? Well, if we go back even further, we can go back 20 years. All right, let's go back 20 years on the value of the US dollar. And this US dollar is the highest it's been in over 20 years. Now, you say a US dollar strong for the economy, right? A US dollar is strong for our economy. True or false? What do y'all think? A strong dollar is strong for our economy. Well, yes and no, right? Our strong US dollar allows us to invest more outside of the United States. That's what it does. A strong US dollar allows us to do a lot more foreign investment outside of the US. However, that US dollar, that strength that the US dollar has, really makes it difficult for foreign money to come into here. Really makes it difficult for foreign money to come into here. And it makes the things that we buy every day cost more. It makes the things that we buy every day cost more, which is also called what? Inflation, right? And our inflation numbers are something that we pay a very close attention to. Now, our CPI number came out this week, and it was a much better than expected number. And the stock market reflected that, right? The stock market reflected that number. If I just look at a very small time frame chart of the stock market reflected, hey, we're excited about the fact that we have lower inflation. And matter of fact, the market on that news shot straight up. We had a big move up on that news. But upon shooting straight up, the market then came right back down, right? Momentarily, that's exactly right, Liz. Momentarily, the market was euphoric. It was unsustainable euphoria that the market had put in place on that increased movement. And so what that tells us is that even though it's getting better, the market's not buying it. And I know it was a small sample and it was just one announcement, but think about it. This week alone, if we think about it, the CPI, our core inflation numbers, were significantly better than expected, which you would think good news for the market. And then the very next day, we get our 50 basis point hike, which everybody expected the 50 basis point hike, but the market didn't react positively. So when I look at what the market is doing right now, I'm going to take a look. Now, this is the S&P 500. When I look at the S&P 500 overall, I'm going to get the story of what the market is doing from this weekly chart. Now, for those of you that are not familiar with what we look at, what we care about more than anything is to reduce it to the ridiculous, right? Reduce it to the ridiculous. And what I care about just looking at the market in terms of swing highs and swing lows. That's it. That's all I care about. Are those, not all I care about, but the most important thing I care about are those swing highs and swing lows. And what we can see in here is that we had our all-time high, which we literally hit an all-time high very, very early in the year, right? Very, very early in the year, we hit our all-time high. We actually hit our all-time high earlier this year, 48.18. We then got a lower low. Once we got a lower low than this low right here, that was the first weekly swing low. Once we eclipsed this price right here, that was a very, very big sign because we eclipsed a swing low. If we go back and look, the last time that the market had broken a prior swing low, you've got to go all the way back to the COVID lows before we had eclipsed a prior swing low. The market just doesn't put in lower swing lows very often on weekly charts in the context of a strong uptrend. Now, we started to come down, we rallied back up. We started to come down, we rallied back up. We went back down, we rallied back up. All the while having lower lows. We had a moment earlier this year where it looked like we were going to pull out of it because we got a higher high. But that higher high was not followed by a higher low. Matter of fact, that higher high was followed by a lower low. So as it stands right now, the market is putting in lower highs and lower lows, right? We had one let's call it a fake outlier earlier this year, and I'm going to come back to this here in a minute because I want to compare this to what happened in 2008 because we had something similar in 08 on our weekly charts. And those of you that are regular members, you saw me talk about this when this happened. But if we go back, and I'm going to take it from a 3-year chart to a longer term chart. Let's go back to 2008. And I'm zooming in on 2008 for a very specific reason. As I look at 2008 on a weekly chart, I got to go back more. There we go. Let me zoom in on just this area. Here we go. So in 2008, we had a scenario right here where we did put in a slightly higher swing high, right? We got above this swing high right here, and we put in a slightly higher one right there. And so now all of a sudden you say, all right, well, we got our higher high. The downtrend is over, right? Because if we look at this using the same kind of picture that we just did, and we look at our swings, right? We were in this kind of a scenario, and then all of a sudden we got a higher high, but the next one was a higher low. And then we put in another lower high, and that's when we saw the true market capitulation, right? Now, market capitulation is a very fancy word that professionals use, and they oftentimes will use the phrase the puke point. The markets right here hit what a lot of the pros call the puke point. And the puke point is when everybody just gets so sick of their portfolio that they just dump all the stock that they have. Now, how far was the market down when that point was hit? Well, when that point was hit, the market had dropped about 25 to 30%, right? We're at 20, 28, 26, somewhere in there, in that range. It had dropped about 25, 26, 28%. And that's when we started to see big banks that were failing, right? Well, let's look at where we are today. Off the high, the market is down at its low was down about 26%. And we put in a higher high, but we were unable, we put in a higher high, but we were unable to put in a higher low, right? And the inability to create a new higher low is one of the most telling signs for the market. And I told this story the other day in a trading room. For those of you that were in the trading room the other day, I talked about when I was watching the France and England soccer match. And I watched the end of the World Cup. And for those of you that are World Cup football fans, there you go, I said it the right way. For those of you that are World Cup football fans, England and France, I thought it was a great game. I really enjoyed watching it. I was rooting for England. I was rooting for the UK. I've been there. I have friends that are from there, ties to there. So I really was pulling for the UK, baby. And with about 2 minutes left before time expired, they had fought and clawed their way back into the game, and it was a 2-1 match. And their best player got the chance to have a penalty kick. Best player, right? Harry Kane steps on the field. I think he's their best player. Pretty sure he's their best player. He's got the opportunity for a penalty kick. They put the ball in his hands. It's just him and the goalie, mano a mano, right? Person to person. And he steps to the ball, and he shakes it out, and he's getting ready, and he gets up to the ball, and he kicks it, and it goes right over the net into the stands. All of a sudden, they immediately, it was like a giant balloon let out all the air. All the air came out of a giant balloon. And so when all of that air came out of that balloon, you could tell that their attempt at a rally had failed. And so now it had no shot. They had no shot. They were dead after that. They were dead. That was our last gasp and our last hope, and they just couldn't mount anything else. Well, when the market puts in a higher high and fails to put in a higher low, you've just sailed the penalty kick over the net. The market sailed the penalty kick over the net with its inability to put in a higher swing low. And so my overall fear is that we haven't really gotten a true fourth quarter move up. We did get a little bit, right? We've gotten a fourth quarter move up here in the last little bit, this rally from here to here over the last few weeks. But that on a daily chart, if I go to a smaller scale, is another example of we were unable to put in a higher high, unable to put in a higher swing high once we had the same swing low. A very similar example to that momentum just being unable to carry forward. And so now what am I looking at? Well, I was cautiously optimistic about the market rallying up from these lows. And part of the reason I was is because our weekly chart had started to give us a little bit of hope coming up here because we came above some key moving averages. Now, as an investor, and I went back and did a lot of studying on this, one of the things that I like to look at for big picture investment sentiment is the 8-period exponential moving average and the 20-period simple moving average. And to make this as simple as possible, it's a simple trading signal that is very good in strong trending markets. Very simply, right? When the market closes below the 20-period exponential moving average, you're out of the market. That's it. You're out. You're out. You are no longer you have no bullish bias. So if you have a 401k or you have an IRA and you're saying, should I be in the market? Well, my belief, and this is my opinion, certainly not advice, speak to your own financial advisor about how you're going to manage your own funds or how they're going to help you to manage your funds. But my personal thought as a management tool is that if we close below a 20-period simple moving average, one of the simplest management tools on earth is to say that if we close below a 20-period simple moving average, get out of the market. Go to cash. Get out. So that would mean that we had a strong signal to get out right here earlier in the year. Very strong signal to get out earlier in the year. Okay? Now, when do I get back in? Well, you get back in when you close above the 8. Well, if I think of it like this, and I'll use red and green arrows as out and in, right? So I had a very strong signal to get out here. Well, then I had a signal to get back in when we closed back above the 8 right here. Strong signal to get back in. Followed pretty quickly by a signal to get right back out. This was quite the head fake, wasn't it? Right? Now, we close back up above the 8 again. We've crossed it a few times this year. And so it gave us another close above the 8 right in here. Right? But then all of a sudden, we drop back down and close below that 20 right in here. So you've had a couple of these in and out kind of periods this year, but you're going to have that sometimes as the market tries to rally back up. Well, we had one more opportunity, and I felt better about it this time around because we did get above the 8 right here, and we stayed above the 8, and we crossed above the 20, and we started to see some momentum. And then this week, we're not officially closed yet below the 20, but the market is basically saying, psych. Now, the good thing about all of these is that all of these are you're in, you're out, you're in, you're out, you're in, you're out. You're typically out a little higher than where you got in, even in a downward trending market, but you're trying to get back in. I want to get back in. I want to be invested in the market if it's going to go up, because here's what sucks. My guess is that a lot of traders got out of the market here and they didn't get back in until here because they were too afraid to get back in early in 2020. My guess is, I'm sure nobody in this webinar did that, but I'm going to guess millions of people did. Millions and millions of people, when the market tanked, they closed out of their positions, their 401ks, their IRAs, and they said, I'm done with it. I'm going to get out. There's too much going on. There's too much unemployment. There's too much of this. There's too much of that. Global pandemic. And they don't get back in until near the top. And once they get back in, what do the professionals start doing? professionals start getting out. And so what I want to do is I don't want to be late to the party. I want to get in early. I'd rather get in and be wrong and then get right back out, right, for a small gain or a small loss than to miss 30% of the move. Does that make sense to everybody? Hopefully that makes sense to everybody. I want to get in early in the rally, as early as I can. And so now, what am I looking at for 2023? Well, first of all, I'm going to do something very important, and I'm going to trade the chart that's in front of me. And right now, if as a swing trader, or excuse me, as an investor or a longer term investor, looking at even, and let's just look at a monthly chart, right? On a monthly time period, we can see clearly that we are in a downward trend. On a weekly chart, very clearly we can see that we're in a downward trend and we're rolling over right now. So where do we stop? Well, here's a hint. I've got some lines. That's exactly right, Vince. Never catch the top or the bottom, but participate in the move while protecting in a fall. And that's exactly it. I'm not going to catch the absolute bottom, and I'm probably not going to catch the absolute top in this style, right? But where do I see the next potential turning point? Well, I've got to look at the next potential turning point overall in big picture market environment. And what I look at for a big picture opportunity to get back in is I need to look for the next high quality area of demand. And my next high quality area of demand, you know, when we identify our zones of demand, let me get rid of all my studies here. I'm going to look down and to the left to the origin of a strong rally in price. Well, certainly, if I look down and to the left to this rally in price, this is not the origin of a strong rally in price. It's been unable to create a new swing high. So that means that I believe that price will, on its next move, cut right back through this level and drop further. So now I need to look lower. And when I look lower than this price, I've got to look further over here. And as I look further and further over here, I come down to this area here. This would be my next origin of a move higher. Now, certainly this is a move higher, and we had a pretty decent move away. But I don't know that I would consider that the origin of a move higher. I think all throughout this area that I have the arrow on is a reaction to the area to the left, right? I think that's a reaction to the area over here to the left. And so as I go a bit lower, I think this is really my next high quality area. And what else is great about this? Well, that is also a whole round number, right? That's a whole round number. 3,000 would be a whole round number where we would have potential market movement, okay? Now, how far is that from where we are today? Well, from where we are today, that's a further drop of 21%. That's a further drop of 20% to get to that area. Well, what kind of a drop would that be from the high? Well, from the high, that would be an overall decline of about 35%. Still less than the 50% market decline that we had in 08, but we're looking at about a 35% correction. Now, what is interesting about 35%? Well, we are certainly deep into bear market territory. And I think this also creates a little bit of what we would call whole round number support as an opportunity for us to potentially get back in that position. Now, do I think we're going to come crashing straight down? Well, not necessarily. I think that we'll probably continue to do what we've done. But that's the other piece. And Liz, thank you for pointing that out. That was really the next thing that I was going to speak to. I don't think that we're going to come smoking down, right? I don't think that we're going to get 3 weeks of just the market absolutely falling apart and dropping down into here, right? I personally don't anticipate that happening. Can it happen? Yes, no question about it. But I don't anticipate that happening. What I anticipate is just much more of this until we reach the puke point. We will reach a puke point. And that puke point might come when people receive their statements, their end of the year statements. Because if you just receive your end of the year statement and you ain't been paying attention all year, and you all of a sudden, you started the year with this much money and you end the year, let's say we end the year right here, a 21% decline. Even if you're putting money into your 401k every year, you're going to have less money that year than you started with, theoretically. Or you have a $200,000 retirement account, you open it up, you now have a $140,000 retirement account, and all of a sudden you're wondering, what's my money manager doing for me? I'm just going to take all my money and move it to what? Move it to cash. Now, when they move it to cash, as they're thinking about moving this thing to cash, now they stop and say, all right, well, if I'm moving this money to cash, I got to do something with it, and I'll buy back in when the market starts to go back up. And so now when they start selling, that's where we'll reach that puke point. And that's where the professional investors will step back in and be willing to buy. Okay. Now, the other piece from a technical perspective that is very important to pay attention to would be the COVID lows all the way up to those highs and looking at our Fibonacci retracements of those levels. And I'm going to put my Fibonacci numbers in here. And what we will see is off of those COVID areas, this puts us really close to the 61.8% retracement off that COVID low to the high. Now that's in the S&P. Let's do the exact same thing in the NASDAQ. Exact same thing in the NASDAQ. And the NASDAQ has been significantly weaker than the S&P in general. If I just throw the 61.8% retracement, we already are there in the NASDAQ, right? The NASDAQ has already hit that 61.8% retracement with an inability to put in a new high. So technology stocks we would still consider to be our weaker play. And the belief would be that we are going to fall further in the NASDAQ as well. Now, the NASDAQ, I think we've already dropped from a percentage movement off the high 37%. So the NASDAQ's already moved that 37%, that I think the S&P still has more movement left in it. So one of the things that we're looking at is, what does our sector rotation model look like? And where are we from our bull to bear market, right? And remembering that as the market and the economy both flow together, what we typically see is that the market starts to rally before the economy fixes itself. So the economy looks typically a bit more like this, right? The economy typically looks, let me get my drawing tool out. Looks a bit more like this, where it bottoms here, and then it starts to come back up. It peaks here, and then starts to go back down. So the economy typically lags the market. So when we're in that recession period, the beginning of a recession, that early recession period, the market's already starting to make its rally back up historically, right? And so are we in the throngs of a recession yet? Well, no, because let's just redefine the term recession so that we're not in one. But when we're thinking about redefining what a recession is, in reality, when people are having a hard time buying groceries, we're in a damn recession. It's a great way to think about it, right? When your grocery bill is 30% higher than it was, and we're starting to see mass layoffs in technology sectors, a recession is coming, or not already there, right? And so the market is clearly down, but the next phase is that bull market coming in. So how do we know when the bull market comes in? Well, when the market starts to get better, and my canary that I'm looking for the coal mine is the financial sector. Because when financials become my leader, technology is soon to follow. Now, why does technology matter? Technology matters Technology matters because technology means people are reinvesting back into those technology pieces. And technology has been the one that has been the worst for a while, right? It's essentially been the worst. Technology, consumer discretionary. When technology starts to come back up, then the market will follow. So I need to see financials and technology to lead us out. Now, we have seen a little bit of help from industrials and basic materials, and that's why the Dow has outperformed the other markets in general. But when I look at what the market is telling me, what the market is telling me now is that for the first quarter of 2023, we have a higher probability of a continued move down. That continued move down gives me a price target in the S&P 500 of around 3,000. That to me is a really good area where the S&P could settle and find a long-term bottom. Do I know that for certain? Absolutely not. And I'm going to trade the dang chart that's in front of me. And so what I'm going to do is keep a very keen eye on the 8 and 20 period simple moving average. When we close below the 8, below the 20, we are out. When we close above the 8, we can get back in. But if we close back below the 20, we're back out again. I would rather start to get back in and then stop. And so here's an analogy, and I give a lot of analogies, so bear with me. I coach baseball. I coach youth baseball. I coach 9-year-old baseball. And one of the things that we try to teach the kid is that it's easier to hit the brakes than it is to hit the gas. And what I mean by that is when those kids are up to bat and they've got the bat in their hand and they're ready to swing, we tell them when the pitcher starts moving, you start your swing. And so we tell them when the pitcher releases the ball, you think yes, and you start to swing. When the ball is halfway to you, you think yes, and you really start to load your body. And then if it's a ball and you can't, and it doesn't make sense to swing, you can hit no. So it's okay to go yes, yes, no. But a lot of kids in their youth, they go no, no, oh yes, it's a strike, and then they swing and then they miss every time. So what we teach the kids is yes, yes, no is easier than no, no, yes, right? Well, think about the market the same way. I would rather start to get back in and then have to get back out than wait for the market to have already moved 20 or 30% back up. So while I think that this makes for a good area where we may see a turning point, I'm also very cognizant of the fact that if we come back into here, if we turn around at 3,500 and we get back up above the 8, I'm still willing to get back in. Right? Still willing to get back in. Now, that's what the SPX looks like with that 8 and 20 moving average. What about the NASDAQ, right? Well, the NASDAQ got back up above the 8, never did close back up above the 20, right? Never did close back up above the 20. So when you're looking at how do I redeploy my capital, I think the SPX is a better overall view of our markets in general because it's got a much better diversification piece to it. You can certainly use the Dow Jones, but the Dow Jones, if you notice, we're above the 20. And we've been above the 20 for the last few weeks. We're still above the 20, right? Got above the 8 a long time ago, still above the 8. But that being said, because it doesn't have the same amount of diversification, it's probably not what's reflected in most of your IRAs and 401k accounts. Okay? And so since that's probably not what's affected in your IRAs and your 401k accounts, it may not be as clear. Now, it might be based on what you're in, but the Dow Jones, remember, only represents 30 U.S. stocks, so it doesn't give us that true bigger picture of diversification that the rest of the markets do. Okay? So, all that to say, number one, trade the chart in front of you. Look for opportunities as they come up, utilizing your tools and the knowledge that you have. Number two, this is important. Stop watching the darn news. Turn the news off. The news is not helping you. The news is not helping you. And the reason that the news is not helping you is because every single piece of news out there is going to have its own piece of commentary built into it. And I took, I did a picture a while ago of I was on, and I'm not bashing Market Watch because essentially they're all the same, right? But I took a picture of it and I thought about it because when I think about what the news tells me is that the news is always going to tells me its own thing. Okay. So here is a picture, and I took this picture a while ago, and I titled it, "This is why I have trust issues." But this was on Market Watch, right? This stock market strategist says the coming recession could be the biggest the biggest ever. I recommend prayer. At the same time, on the same day, the drop in expected S&P earnings is the sweet spot for big stock market gains over the next 12 months. Damn it, it's on the same website, on the same page, next to each other. Come on, man. What that tells me is that you're going to pay attention to the news that follows your inherent bias. Get rid of the inherent bias, right? Get rid of the inherent bias as it exists, because that inherent bias will eat you up and spit you out, okay? That inherent bias will eat you up and spit you out. So hopefully this makes sense. And when Corey and I look about, what we do at TradersArmy on a pretty regular basis is we just try to continually give people updates of what's happening and what's going on in the markets. And hopefully tonight has been a little bit of an eye-opening piece for where we think the markets may go. But remember, I don't have a bias. If the chart tells me to get back in, I get back in. If the chart tells me to stay the heck out, I stay the heck out. And that's really what I care about, and that's what I want to stress to you all. So I don't rely on any news at all, because any news is going to be biased except for potentially news releases, right? So when is something going to be released? Like the 50 basis point hike. I knew I wasn't taking a trade around that announcement. That's really the only news that I care about at places like Forex Factory or things like that, is I'll use the news calendar to tell me when I should or shouldn't be into the position. So hopefully it's a great opportunity to kind of touch base, see each other. If you're not a TradersArmy member, I invite you to join us. We've got a promo code. It's just Trader60, TRADER 60, gives you your first month for 60% off. Love to have you. If we're not worth $60 a month, then we really do suck. But come on in, see what we're all about. Come join the team. I'd love to have you. I think that's it'd be great to kind of expand our network and membership and people that we have, and hopefully we can help you to make a little bit of cheddar, a little bit of coins. So that's all I have for today, everybody. I appreciate you joining me this evening. I want you all to have a Merry Christmas, a Happy Holidays, a happy, safe New Year. You guys are all in our regular family prayer intentions. Believe it or not, I absolutely adore the community that we've built at TradersArmy. And there's nothing that makes Corey and I happier than when people send me a text or they send me an email. And I mean, the phone, when you text us, when you text the number that's on the website, it goes right to my phone. Like, we get it. When I hear what you guys have to say about, hey, I just made X amount on a trade, or, hey, I just had a $30,000 month, like, that's what keeps Corey and I doing this, right? Me and Corey and Herman and our team comes back day over day because we like to see people succeed, and we appreciate you being here. So thanks so much, everybody. I hope you guys have a phenomenal night. And if you guys have any questions, please feel free to